All right, so we're going to take a look at Chapter 10, long-term assets. So taking a look at long-term assets, what it really is anything that has a useful life of more than a year. So for instance, a laptop we expect to last longer than a year, buildings, and also anything that we're not going to receive within a year. So for instance, if, my mortgage company isn't going to receive my entire mortgage this year, so what I'm not paying in the next 12 months would actually be long term. So they're not intended for resale to customers and different things, and they're used in the operation of a business. So property and equipment, cars, we expect all of these things to last longer than a year. So under accrual accounting, the cost of these assets, with the exception of land and some intangibles, can be allocated because they benefit different years. So with that being said, long-term assets are generally reported at carrying value. And carrying value is also known as book value, and it's basically the unexpired part of an asset's cost. So what happens, and we'll get into it a little bit more, is when I buy, a car and I continue to drive it, essentially that's losing value. So in accounting, what we do is actually we depreciate over what we expect the useful life is. So something like a laptop, I'd say 2 to 3 years. Laptops don't normally last longer than 2 to 3 years anymore. Something like a car, I expect my car to last at least 5. So we would depreciate it over that. So with that also comes asset impairment. And it's basically, it occurs when the carrying value of a long-term asset exceeds its fair value. So basically, the amount I have it on my books, I couldn't sell it for. I could only sell it for less than that. So that's when an asset is impaired. So recognition of the acquisition cost of a long-term asset. So an expenditure is a payment or an obligation to make a future payment of an asset. The expenditures are normally capitalized, and there's 2 ways. It's a capital expenditure or it's a revenue expenditure. So capital expenditure is a purchase or an expansion of a long-term asset, whereas revenue expenditure is in the ordinary repairs and maintenance needed to keep a long-term asset in condition. So revenue expenditures are actually expense. So one of these example is, I have a car and I've capitalized my car because I'm going to drive it for more than 5 years in my business, but I get a flat tire. That flat tire and replacing that tire is a revenue expenditure. I don't bother putting it on my books and depreciating the $200 tire for 5 years. I just expense it. So the capital expenditures include outlays for plant assets. It can also include natural resources and intangibles. So additions are anything that's been done to the physical layout of the plant. Betterments are any improvements to the plant asset, but not to additions. So it doesn't physically change the plant's layout and such. And then extraordinary repairs are repairs that significantly enhance the asset's useful life or residual value. And those are actually recorded reducing accumulated depreciation. You don't really see many of those. And then the distinction between capital and revenue expenditures is very important in applying accrual, because you would capitalize the capitalized additions. So the acquisition cost of plant, property, and equipment, which I'll just refer to as PP&E, includes all expenditures reasonably necessary to get the asset in place and ready. So different things like freight. So you buy a big machine. They're not just going to say, oh, here's, your $200,000 machine. I'll ship it to you for free. No, they're going to charge you. Most likely it should weigh a lot, essentially. And then also you can't just, it comes off the delivery truck and it's ready to go. Someone has to install it. Someone has to put the water pipe into the machine and whatnot. So those items can be capitalized along with the $200,000 purchase price. There's also interest charges incurred in the purchase of the asset are not capitalized. They're an expense. So because I had to take out a loan to buy this $200,000 machine, I can't just add that to the cost of it. So small expenditures for long-term assets may be treated as an expense if they are not material. So for instance, that would be my tire example for the car. Land is an expenditure. That should be debited to the land account and includes the purchase price of the land, any commissions you pay to the real estate agent, lawyer's fees, accrued taxes, and such you pay, and the cost of preparing the land to build on it. So certain things like you need to, MGM right now is tearing down a lot of the buildings. That would matter. That would go into the cost of the land. The interesting thing about the land, though, land itself you cannot depreciate. Land stays the same. So if I paid $200,000 for my land, basically to get rid of the building and everything, it's $200,000. It will never change, essentially because you can always sell the land. Then land improvements are improvements to real estate, such as a driveway, a parking lot, fences. They have a limited life, and they're subject to depreciation, and they're recorded in an account called land improvements. Why? Because they have a limited life. My fence has a certain life. The driveway I'm going to have to repave and things. So determining the acquisition, when a company buys a building, the cost includes the purchase price and any expenditures ready to make it into a usable condition. So, I need access into that. I need to put, lighting into the building and such. All of those items matter. When a company constructs its own building, the costs include costs of material, labors, and overhead, architect's fees, lawyer's fees, insurance during construction, and actually interest on the construction loan, because it's all part of building the building. So the only time you can capitalize the interest is when it's in a construction loan. So taking a look at leasehold improvements, they're improvements to leased property, such as you install a carpet or a wall or books of the property. So basically you don't own the property, you're just leasing it and making payments. They're usually classified as PP&E in the section of the balance sheet. And the cost of these improvements are depreciated over the remaining term of the lease. So if you have a lease for 24 months, you would depreciate that over 24 months. Equipment, the cost of equipment includes expenditures connected with purchasing the equipment and preparing it for use. These expenditures can include invoices, price, any discounts you've taken. You would deduct those, freight, insurance, tariffs. So a lot of times if you're buying equipment from another country and shipping it overseas, you obviously have to insure it. You have to pay some excise tax, some tariffs and such, and all of those can be capitalized with it. Companies sometimes make a group purchase, such as land and other assets, for a lump sum. This lump sum has to be allocated, also known as apportioned, between the land and other assets. So a lot of times when you get like a real estate tax bill for your house, it'll have the value of the land and the value of the building. So that would help you figure that out. Depreciation refers to the allocation of costs and plant assets over its useful life, not to the asset's physical deterioration or the fact that it's decreased in value. So the major factors that limit their asset's useful life is physical deterioration. So if something's happened, like all of a sudden, the piece of metal was left outside or the sun got to it and the wind, that would obviously affect your useful life. And then if it's obsolete, so think of computers. I mean, the computers we use nowadays, we're not going back and using Windows XP. We're not buying it with those items anymore. So it's not really easy for someone to sell at top dollar those items. So depreciation is recorded even if an asset increases in value. So although the housing market changes and such, so the cost of a company's building, they tax it at $2 million, but they only paid 1.8. You're not depreciating the 2, you're still just depreciating the 1.8. We do not adjust for fair market value. We only go off of the cost of the items. So factors in computing depreciation: the cost, it's the net purchase price plus the expenditures we've already talked about. Also, the residual value. So this is the portion of an asset's cost that a company expects to recover when it disposes of an asset. So, for instance, a car. You'll always get something for a car, right? The majority of the time, you can see signs, push, pull, tow, $500. So, at least to be reasonable, you would expect that I buy a $10,000 car, it has a residual value of, $500. So then the depreciable cost is the asset, so the 10,000 less the 500, which would give you 9,500. The estimated life is the total number of service units expected for the long-term assets. Could be in years. You could also do something like units produced if it's a machine producing items, or you can do for a car, you can do miles driven. There's certainly different methods. So an accelerated method, which we use for tax purposes a lot of the times, and different things, is you can use double declining balance, which basically the depreciation results in larger amounts of depreciation in the early years of the asset. So depreciation charges will be highest in the years when the asset is newer, and when the most revenue is generated from the asset is likely to be higher. So think about it. If you have a brand new machine, you're likely using it more than you will, 10 years down the line. Is the thought process behind that. Group depreciation. Here's some special issues. Group depreciation. Large companies group similar assets such as machines and then calculate depreciation. It is often necessary to calculate depreciation for partial years because assets have been purchased mid-year. The tax law allows rapid write-offs of plant assets, which differs from depreciation methods most companies use for financial reporting. So tax basically has tax changes every year essentially. So they have, although the slide says 250,000, it's really the first 500,000 based on asset additions under $2 million. And then there's a pro rata reduction for that. So what that means is tax law does not follow GAAP. Tax is allowed to depreciate items at a faster rate, which most people do. Sometimes the estimated life can be revised so that the depreciation changes over it. So basically, if I'm 3 years into an asset and I said it would have a 3-year life, a 5-year life, but my asset is done, or I think, this is only going to last 1 more year, I can make those adjustments. And that's really just called the change in accounting estimate. So when the plant assets are no longer useful because they have physically deteriorated, become obsolete, or a company can sell them, disregard them, or trade them in for a new asset, the company must record depreciation expense for the partial time it used it. So if I get rid of it as of April 15th, then I can depreciate it up until the 15th. So the carrying value of the fully depreciated asset, if it's 0, it has no residual value. When the asset is discarded, no gain or loss is resulted. So basically, I don't sell it; I just get rid of it. The asset's no longer useful. It's been completely depreciated in my books, so it's a 0 transaction essentially. For an asset with a carrying value, a loss equal to the carrying value should be recorded. So basically, if I still have remaining costs, so I have a $20,000 asset, I've depreciated $10,000 of that, but it's no longer useful, I would have a $10,000 loss. So you can also exchange for similar items, such as an old machine traded in for newer, or you see this a lot of times for cars. So sometimes you'll trade in your old one, get a new one, and get an allowance essentially for it. So in both cases, the purchase price is reduced by the amount of the trade-in allowance. So if the trade-in is greater than the asset's carrying value, the company recognizes a gain. Otherwise, it would recognize a loss. And we'll do some homework problems that calculate this out. So natural resources are also long-term assets. So what this is it's converted to inventory. So once you start cutting it up, pumping it, mining the oil, pumping the oil, mining the rocks and stuff, you have to record that as inventory because basically you're going to sell it. So they are recorded acquisition costs. As these resources are converted into inventory, their inventory must be proportionately reduced. So you have to do it in a proper manner. The useful life of the plant's assets used to extract the natural resources may be longer than the time it will take to extract resources itself. So a company plans to abandon these assets after all the resources have been extracted. They should then depreciate on the same basis. So I can't say the machine getting rid, the machine extracting all my inventory and rocks has a 10-year life, whereas, the actual pit where I'm getting my rocks has a 5. You have to make it consistent. Depletion. Depletion refers to the exhaustion of a natural resource, but also to the proportionate allocation of the national resource. So what happens, the depletion cost per unit is cost less the residual value, so whatever they can sell the pit for in the end and such, divided by the estimated number of units. So how many units do I think this is going to be produced? And people do this quite often. So this isn't just an unusual thing. So a lot of it is the oil and gas industry. So exploring and developing oil and gas resources can be accounted for in 2 methods. Successful efforts accounting, which is under this method, the cost of successful exploration is a cost of the resource itself. And that's recorded and depleted over the estimated life. The cost of unsuccessful exploration is then written off. And then the full costing method, all costs of explorations are recorded as assets and depleted over the useful life. This includes the costs of unsuccessful, such as, drilling a hole and it being dry. Intangible assets comes from very long-term rights it affords its users. So think of different things like a trademark and different things. Here's some items. So intangible assets are accounted for that the company in the amount the company paid for them and should be included on the balance sheet only if they purchased from another party at a price. So just because I, have a great customer list and my customer list is worth a lot, I can't just go and record myself an asset. I actually have to buy another company's customer list to then record it as an asset because I had to pay something for it. So the useful life of an intangibles in the period in which it is expected to contribute to the companies. So definite, it would have a legal limit. So my patent can only last for 7 years, therefore I can only have it on my books for 7 years. And indefinite would be not limited legally, contractually, or competitive. And that should just stay on the books. You can't actually amortize that because the life is never ending. So research and development activities include the development of new products, testing of existing and proposed products. So FASB requires that all R&D costs be charged to expense in the period in which they occurred. The costs that companies incur and develop internal software, developing software for sale or lease on their own are considered R&D costs and the product until the product has been proven feasible. So once proved feasible, all software production costs are recorded as an asset and amortized over the estimated useful life of the asset using straight line depreciation. So then there's goodwill. Goodwill is basically I bought a company and I paid more than it was worth. So your company is valued at $1 million. I paid you $2 million. I'm sorry, I paid you $1.5 million. Therefore, I have $500,000 of goodwill. So goodwill may reflect customer satisfaction, management's efficiency, good locations and such. So the FASB requires that goodwill be reported as a separate line item on the balance sheet and that annually you look at it and say if it's impaired. So if I bought a business and the business is sinking, then the goodwill for that business would also be impaired. So a company may need to finance major acquisitions of long-term assets. So the way you finance things in corporate world is you either sell stock, you do a long-term note, or you do a bond. So with that being said, the measure of a company's success in funding these items is free cash flow. Free cash flow is the amount of cash that remains after deducting the funds a company must commit. to continue its operations. So what that means is it's after you take away current continuing operations, income taxes, dividends, net capital expenditures, and such will equal your free cash flow. So it's computed net cash flows from operating activities, less dividends, less purchase of assets, plus the sale of any assets. So positive cash flow means the company has met all its cash commitments that it has to use, and then negative cash flow means it will have to sell some investments, borrow money, or issue stock to continue going. So when a company acquires long-term assets, it defers some of the assets' cost to a later period. So what that means is I decide, it's an estimate, if the long-term asset has 5 years, 3 years, or really should, be capitalized in general. So a lot of what happens is fraudulently, someone can look at their bottom line, say, I need $1 million here, and capitalize a bunch of items that shouldn't be capitalized. So there are a lot of ethics in this. So the way to resolve this is management must answer 4 questions. How is the cost of long-term asset determined? How should the expired portion of the cost of the long-term assets be allocated against revenue? And how should subsequent expenditures such as repairs and additions be treated? And how should the disposal be recorded? So all of these items, really come down to, is management looking at these items? Are they capitalizing things not because of their bottom line, but because it has a longer asset life? All of these items play into it. So what we're going to take a look at more or less during this chapter is really depreciation, for which the book goes over thorough examples. And if you take a look at the chapter 9 and 10 slide, I've gone through straight line method, double declining balance, and production method for you to take a look at for that. Please let me know if you have any questions on these items.